Here is a man who, with a single phone call, could buy a piece of almost any company on earth. A man whose name alone moves markets, whose every investment is studied like scripture by people who manage trillions. And when it came time for him to write down in his own will what should happen to the money he leaves behind for the person he loves most in this world, his wife, he did not point her towards some secret, sophisticated, billionaire-only investment. He did not even point her toward his own company, the one he built into one of the most valuable businesses on the planet. Instead, he gave an instruction so plain, so almost insultingly simple, that a person with no financial knowledge at all could follow it in a single afternoon. And the fact that this is what Warren Buffett chose for the one inheritance that matters to him most tells you more about how money actually works than 1,000 hours of financial television ever could. Stay with me because in the next few minutes I am going to show you exactly what that one fund is, the precise instruction he wrote, why a genius would choose the one thing that requires no genius, and one honest warning about copying it that almost nobody mentions. It came out in his 2013 letter to the shareholders of his company, a letter read every year by millions of investors hunting for wisdom. And buried in it, Buffett did something unusual. He revealed a piece of his own will. He explained that when he is gone, a sum of cash will be left to a trustee for his wife's benefit. And he wrote down the advice he was giving that trustee for how to handle it. His exact instruction was about as short as financial advice can get. Put 10% of the cash in short-term government bonds and put the other 90% in a very low-cost S&P 500 index fund. And he added in a quiet parenthesis a single suggestion of which one, Vanguard's. Now sit with how strange that is for a moment, because if you miss the strangeness, you miss the whole lesson. This is the most celebrated stock picker in modern history. People have paid enormous sums simply to have lunch with him and ask what to buy. He could have directed that money into hand-picked companies, into private deals ordinary people never see, into the kind of complex strategies that the wealthy are constantly told they need. He could have, very reasonably, told her to keep it all in shares of his own Berkshire Hathaway, and he chose none of that. He chose a fund that simply owns a slice of America's 500 largest companies, tracks the market, and does nothing clever at all. A fund that charges almost nothing because there is no highly paid genius behind it making bold calls. The greatest active investor alive told the love of his life to be essentially a completely passive one. That is not a contradiction. That is the punchline of his entire philosophy. So let me explain what the one fund actually is, because the name sounds more intimidating than the thing itself. An S&P 500 index fund is just a single investment that holds small pieces of the 500 biggest publicly traded companies in the United States. The household names you already know across technology, banking, healthcare, energy, retail, all of it, bundled together. When those companies as a group do well over the years, the fund does well. There is no manager trying to outsmart anyone, no frantic buying and selling, no expensive team to pay. And that last part, the cost, is the secret hiding in plain sight. Buffett used the words very low cost on purpose, because the whole reason he trusts this fund is the same reason he has spent decades warning people about the alternative. Here is the reasoning, in his own logic. Most people who try to beat the market or who pay professionals to beat the market for them end up behind, not because they are foolish, but because of fees and human emotion. The clever-sounding managers charge high fees every single year, win or lose, and those fees compound against you, quietly subtracting from your wealth decade after decade. Meanwhile, ordinary investors tend to do the worst thing at the worst time. They get excited and pile in when prices are high, and they panic and sell when prices crash. Buffett's simple fund sidesteps both traps. The cost is tiny, so almost nothing is skimmed off the top. And there is nothing to tinker with, nothing to outsmart, no salesman whispering about the next hot opportunity. He even said plainly that he believed this boring approach would, over the long run, beat what most investors achieve, including big pension funds and institutions paying for the smartest help money can buy. He wasn't guessing. This is the same man who famously won a $1 million 10-year public bet, proving that a plain index fund would crush a basket of elite hedge funds. And it did by a landslide. His will is simply that same conviction, written for the person he cannot bear to see taken advantage of after he's gone. And that, I think, is the real heart of this story. Read his instruction again, and notice what he was actually protecting her from. He wasn't only chasing the highest possible return, he was building something that could not be ruined by bad advice, by complexity, by some confident stranger in a nice suit who shows up the moment a wealthy widow has money to invest. He gave her something so simple that no one could talk her out of it and into something worse. He removed the need for her to be an expert, to monitor the markets, to make clever decisions under pressure. He gave her peace. For a man who has spent his life thinking about money, the most loving financial gift he could imagine was not cleverness. It was the freedom to never have to be clever at all. But now I owe you the honest warning, because this is exactly where these stories usually go wrong and start hurting the people who trust them. You should not hear Warren Buffett put 90% into stocks and rush to copy it tonight, and here is the crucial reason why. That 90-10 split works for his wife specifically because the fortune behind it is enormous, large enough to absorb a brutal market crash without ever threatening her daily life. Putting 90% into the stock market means your money will at some point ride straight through frightening drops. The market can and does fall by 30, 40, even 50% in a bad stretch before recovering. If you have a vast estate, you can simply wait it out and never feel it. But if you are an ordinary person or near retirement, or you might actually need that money in the next few years, that same 90% could mean watching a huge piece of your savings vanish on paper right when you can least afford it and being forced to sell at the bottom to pay your bills. That is the opposite of safety. This is why many sensible advisors would tell a normal saver to first build an emergency cash reserve covering several months of expenses and to hold more in safer assets and less in stocks than Buffett's wife does, scaled to your own age, your own timeline, and how much of a drop you could truly stomach without panicking. The principle Buffett is teaching, low cost, simplicity, patience, is for everyone. The exact 90-10 recipe is not. Please take the lesson and get advice suited to your own life before you ever touch the formula. Nothing here is a recommendation for your particular situation. With that honestly said, the lesson underneath is a genuine gift, and it travels well beyond America. Whether you are watching from the United States, the United Kingdom, Canada, or the Philippines, the same kind of low-cost, broadly diversified index fund exists where you live and is available to ordinary people, not just billionaires. The specific fund Buffett named is American, but the idea behind it is universal. Own a wide basket of solid companies. Keep your costs as low as humanly possible. Stop trying to outsmart the market and give it time. What makes it powerful is not any magic in the fund itself. It is the discipline it forces on you. The discipline of doing less, paying less, and staying calm while everyone around you is reacting to headlines. Buffett's deepest insight is almost spiritual in its simplicity. In investing, effort and expense are usually punished, while patience and humility are usually rewarded. The person who does the least, as long as they do it cheaply and consistently, very often beats the person who does the most. So here's what I want you to carry away from a billionaire's will. The most telling decision a man of his wealth could ever make is not what he bought to get rich. It is what he chose to leave behind for the person he loves. And he chose simplicity over genius, low cost over prestige, peace over cleverness. He could have left her a puzzle that only experts could solve. Instead, he left her something she would never have to worry about, never have to manage, never be talked out of. That, in the end, is the quiet message hidden inside one boring index fund. The goal was never to look smart. The goal was to be free. And the strange, beautiful truth is that for most of us, the path to that same freedom is sitting right out in the open, costs almost nothing, and asks only one hard thing in return: the patience to leave it alone.